Hello everybody. Quickly about retirement, how you get to retirement. The main, you have to have a goal, you should write them down, financial goals. Most people don't do it. Trading, what I said so often before, is trading doesn't pay off. You can find great companies in an index of a country. In the US you have the S&P 500, the Dow Jones 30. The greatest and largest companies of a country are in those indices. We have in Germany the DAX 30 companies, blue chip German companies are in there. You have in Austria the ATX. And so every country has its own, and shop there, check it, pick the best companies you have, and then let them grow, let them go, those stocks. It's a amazing thing what happens when you let them compound. And most people don't understand the effects of compound. And it sounds so stupid to sell diapers and razor blades, but Procter & Gamble is doing that. And if you would have invested since January 1970, so in 40 some years, you would have made 4,629%. It's a great performance. It's called compounding. And it's calculated as you would reinvest the dividends. Amazon went up since May 1997. It went up 23,810%. It's an amazing thing. Since they went public, it's a machine. Colgate Palmolive, it was huge at that time. Since January 1977, it went up 4,500%. Nike, since they went public December 1980, it went up 23,526%. If Nike, the stock was 30 cents when they came public, take out the splits, 30 cents, and today the stock is like $77 or $78. So that shows you, since 1980, just a Nike stock, 23,500 some percent. That is amazing. It shows you the effect of compounding. Let them grow, and you make money on the stock market. People misunderstand a lot of things. How do you make money? Who's making the money? Those companies that produce beer, creams, bread, cell phones, computers, sports shoes, software, oil, energy. Those are the companies that produce the earnings, not the financial company. They invest in those. And so those boring stuff, also interesting stuff, internet and software, they are producing the earnings. It's not the fund manager that is creating it, those companies that produce everyday stuff. So what is important when you save for the stock market, for your retirement? Watch the fees, the banking fees, watch the fund fees they charge you, watch the taxes, watch the fees to have a portfolio. All these costs at the end of the day are important. So the lower the fees, the better usually you do. Nobody knows the future, so you should be careful of those that tell you exactly the future. It's overconfidence people. Some people are really narcissists. They think they are wonderful and know everything. That's stupid stuff. Don't believe it. Nobody can tell you where a stock will be in 1 year or where the index will be exactly in 2 years. It's all bullshit. Don't trust them. Long term the stock market goes up, but where it will be exactly, or a single stock, nobody knows. Don't jump in and out of the stock market. Keep it, hold it. It's a waste of money, of fees, it's a waste of time. If there's a trader that says he did win, there's another trader that has lost kind of the same amount. So at the end of the day, it neutralizes itself. One trader is good, one trader is bad. So after costs, there is a negative effect on them. I don't sell my stocks, I keep them for the long run. And I just buy what I know, what I understand. And I started small, I'm patient. I keep my savings rate. If I can, I increase. I put a little more in the savings. And over the decades, you will see what fantastic tool it is. Boring stocks I like the most. The average investor, most people run after interesting hot themes, but they are mostly very short in life and they are very expensive, those trendy stocks. So I would say stay away from them or buy companies that are a little bit in trouble, that have problems. They are usually cheaper and most blue chips can solve them, most. And don't be anxious, don't be euphoric, don't be overconfident, don't be impatient. That costs you all money, doesn't pay off. Just buy what you would keep, what you would hold to perfectly. You would be happy even if the stock market would shut down for 10 years. That's what Buffett recommends to do. You should do the same. Just buy what you can hold to and what you feel very well for keeping it for 10 years minimum. The daily stock movements up and down are nonsense. There's no rationale behind them. It's sometimes based on random things. There's one large important fund that sells, and there's no meaning behind it. What I would say, it's like change of the weather every day. A rainy day, a sunny day. Don't check. That's what I would say. Don't check every day the stock market. It distracts you from your long-term goals. Don't check the quarterly results all the time and get nervous about it. If you have a great company, they will have a bad quarter, of course. So the Dow Jones makes average 10%. That shows the history. The German DAX makes 7% average a year since it was started. Stocks, equities are the best asset class I think you can have, and they are a great tool for your retirement because they are the best performing assets out there. A crash is a great gift for you. If the stock market will crash, buy more, get as much as you can. A crash is not a horrible thing. It is a huge opportunity. You should change your perspective of it. And some governments, like for example the Germans, they did not understand how important a stock is for a society, how they easily can build up retirement savings, and this is a sad thing. So some governments are helping people through the stock market to build up. They can benefit through the compounding, they have tax benefits. The American government is doing, I think, a very great thing with offering 401ks and SEP IRAs and how you call them, Roth IRAs. It's a fantastic tool. Other countries have to, I would recommend to follow them and install tools like the Americans have for their population. That's all for today. Bye.